Hello all, welcome back to Commerce Masters Income Tax Basic Concepts class. Today we are going to the last part of Income Tax Basic Concept, that is part 9. The last classes we have been discussing the basic meaning definitions of the different terms and income tax rates for the for the current assessment year and for the past assessment years and the coming assessment years, and income tax incidents and all these things we have discussed in the last class. Today we are going to move the tax planning in respect of income tax, in respect of residential status. And you know how the residential status of one person is determined. We have learned, you just remind, we have learned two basic conditions and two additional conditions and exceptions to the additional conditions, and how the residential status of one person is, or one individual is determined. Okay, and after that we learned what income is taxable to resident and what income is taxable to non-resident, and what income will be taxable to ordinarily and not ordinarily residents, and the differences of that. I have showed you that incidence of taxes in a chart. You just remind that before coming to this class. And here in this chapter, in this part, we are going to learn the incidence of this tax planning for the tax planning in respect of the residential status of the individual. Okay, you know that some incomes are not taxable to the all the individual. So the individual can plan his income or his residential status in such a way that he need not pay tax. That is the tax planning in this case. Okay, if one person staying outside India for a major of time during the year and the preceding years, he can keep some points in mind so that if they are capable of adjusting their schedule, they can save a lot of tax by proper tax planning. You know that many of our family members are working outside in Gulf countries or in outside some foreign countries and all, and they are not coming here in India frequently, but they are coming for 2 months vacation or like that. They are coming, so they are earning some money there, and they are taking that money, remitting that money to India. And how they can plan their residential status in order to save their tax liability, in order to escape from the tax liability. This is what our tax planning in respect of the residential status. You know that if one person is staying in India for 182 days during the previous year, he will be resident in India. So all the incomes he earned in India, outside India, will be taxable in India. If he says at least 6 months in India, that is 182 days in India. Okay. And another basic condition is that if one person is staying in India and he has been in India for at least 360 days during the last 4 previous years preceding the current previous year, he is called resident in India. Okay. So if he is becoming the resident in India, he will have to pay tax for all the incomes that he may earn outside India and remit to India, or he may earn in India, like that. Okay, you know the tax liability incidence of taxes, and I shall just show you that table again. So before that, you just see, if one person working outside or major of his time he is staying outside, how can he plan his schedule, or how can schedule means how can he plan his vacation in India, how he has to stay here in India, like that. You just see, individual who are visiting in India on a business trip or in some other connection should not stay in India for more than 181 days. If one person is coming to India to visit in India, that is if he is an Indian citizen or he is an Indian origin, maybe like that. So if he is staying in India for at least 182 days in India, he will become resident in India. Actually, in the real situation, he may not have any job in India, he may not have any business in India, he may not be earning any income in India. He is earning all his incomes outside India, but he came here for a trip, for a business trip, or for a family visit, or for a vacation, like that. And he stayed in India for 182 days minimum. He has become a resident in India. If he becomes resident in India, he will have to pay taxes for all the incomes he earned outside India. Okay, so how can he plan his schedule or his visit? He should not visit in India, or he should not stay in India for 182 days. He has to plan his schedule or stay for a maximum of 181 days. Got the idea? Okay, this was the first basic condition. And in the year, and not more than 364 days in the preceding 4 years to enjoy non-resident status. And he should not be here, and he has to check that he should not be here for 364 days in the 4 previous years, just preceding the previous year. That was the first condition. And you just see, if an individual is in India for more than 364 days during the previous preceding 4 years, in case one individual had been in India for more than 364 days during the previous preceding 4 previous years, then he should avoid staying in India for more than 59 days in a year. What is that? The second basic condition was like, the first basic condition was 182 days. If he is staying in India for 182 days, he will become a resident in India. So he should not stay in India for more than 181 days. The second condition was, if one person is in India for at least 60 days, and he has been in India for 364 days in the 4 previous years, just preceding the previous year, the current previous year. Okay, this was the second basic condition to become a resident. So, in case, suppose one person had been in India for at least 364 days during the 4 previous years, just preceding the current previous year, he had been in India, suppose. Then he has to plan his visit in this current previous year in such a way that he should not stay in India for a period of 60 days. He has to limit his visit or stay in India for a maximum days of 59 days. You got the idea? If he stay here for the 60th day, he'll become the resident in India, and he will have to pay the taxes for the incomes he earn outside. If he becomes a resident in India, he will have to pay the taxes for the for the income he earn outside. So he should not stay in India for a period of 60 days during the previous year. If he had been in India for a period of 364 days in India. Got the idea? Okay. Then, if he has to stay in India for a period of more than 60 days, what he has to do? He has to stretch these 60 days, all these his visit, he has to stretch to 2 financial years. Like he comes in India in 2nd February, like that, February, March, he can stay in India. So it will become some 58 or 59 days in India in that previous year. And next April and May he can stay in India up to May 29th. So he can stay in India for 128 days. He can stay in India 118 days or 119 days, like that. But if we are taking 1 previous year, he will be in India only for 59 days or like that. Okay, he stretched his visit into 2 financial years. So in first financial year, he came here in India in February 2nd, and February, March will become in first financial year, and then from April to April, the next financial year is starting. So in the one financial year, he will be in India only for 59 days, like that. Okay, he can plan his visit like that. So it is the planning to reduce his tax liability in case of residential status. Okay, similarly, An Indian citizen or person of Indian origin should plan their trip such that no more than 181 days will fall in 1 year. I have already explained to you. And non-resident should not receive any income directly in India. If a non-resident receives his income in India, he will have to pay taxes for that. So he should not receive any income directly in India, even if the business is controlled directly from India. He should not receive the income in India. Okay, he should first receive income outside India and then remit to India. If he has to receive or he has to get that money in India, what he has to do? He has to receive that income outside India, and he has to remit that further. He can remit that income to India. Okay, like that he can plan. And he should not first receive income outside India and then remit to India. By such a way, no tax is leviable on such income. Okay. Then, similarly, a non-ordinary resident should receive his income outside India, which is earned outside India and from a business controlled outside India. You got the idea? If you're looking at the chart, in the last classes I had showed you that chart. I will just show you that. You see, this was our instance of taxes. For the non-resident and a resident but ordinary, not ordinary resident, like that, you just see what are the incomes taxable. Income accrued or deemed to be accrued in and received or deemed to receive in India will be taxable to everyone. And income accrued outside India but received or deemed to be received in India, this will be taxable to everyone. So tax planning for this ordinarily and not ordinarily resident and non-resident, you just see, if a non-resident person or individual received his income in India, he will have to pay taxes for the income he earned outside. Okay, so he should not receive income. He should not receive income in India. What he has to do, he has to receive the income outside India, and further he can remit this money to India, then he need not pay taxes. Like that, these incidents of taxes, you just see these incidents of taxes, and accordingly we can plan our income. According to our plan, we can avoid the tax liability. Okay. And here you see, similarly, a non-ordinary resident should receive his income outside India, which is earned outside India, and from a business controlled outside India. A non-resident should receive his income he earned and outside India from a business that he controlled outside India. Because if for a non-resident, for a not ordinarily resident, income received or accrued outside India from a business controlled outside India will not be taxable. But if that business is controlled from India, it will be taxable. Or from a business, income received in India will be taxable, or accrue to be received in India will be taxable. So he should not receive that money in India if his business is controlled outside India. Okay. Then these are the tax planning, and for all the incidents of taxes we can plan it like that. For incidents of taxes, I had showed you that many categories are there. For each category we can plan our residential status or receiving of this money in such a way that the tax liability will be reduced as far as the individual is concerned. Okay, this is the tax planning for an individual in respect of his residential status. Okay, then we are going to move to the exempted incomes. Exempted income means the incomes on which income tax is not chargeable. If income tax is not chargeable for an income, this income is called exempted income. So such incomes can be classified into two categories. The first category is income which are neither included in total income nor income tax is payable on them. But the meaning, this is neither included nor it is taxable. And another category, the second category, is incomes which are included in the total income. First, it will be included in the total income, but are exempted from the tax at the average rate of income tax applicable to the total income. Okay, and I've given you some example on that. These are the example of the first category. The first category was income which are neither included in the total income or no income tax is payable on them. I have given you some 10 or 12 examples, and in the textbook you can see some 85 to 85 or 86 like that examples you can see. But here I have included only 12 items, 12 or 13 items like that I have included, because these items are will be very familiar to you in the coming classes. It will be discussing further, because in all the in the salary income, from salary income, from house property income, from business or income from other income like that, in everywhere you can, every chapters you can see that these items are coming, special treatment for these items are coming. So that's why I have included these items in this chapter. And there are many incomes like that. If I remember correctly, it is some 85 items are there. So you have to just read, you have to just go through that and remember some items. If it is asked for the examination, you have to write some 2-3 pages or so. Just remember all the items. And here I have included some important and common items. You just see the first income is agricultural income. Agricultural income is not taxable, and sums received from HUF. If one person, one member of the HUF is receiving some income from his karta, from his head, that is not taxable for that person, that member. Okay, because that members are not taxable for under Income Tax Act. Only the karta will be, the HUF means the karta will be taxable. Karta will be will have to pay the taxes for the incomes that family earns. So if one person, one member of the HUF receives some money from the karta, he need not pay any taxes for that. And share of a partner of business, interest received by non-resident, and travel concessions, allowance or perquisites outside India. If anyone receives allowance or perquisites outside India, this is not taxable. Gratuity, encashment of earned leave, retrenchment compensation, compensation in disaster. And this gratuity, encashment of earned leave, and payment of voluntary retirement, all these things you will study in the coming chapters. Salary, in the chapter of salary you can see all these things. And this compensation on disaster, it is like that the government will be paying some disaster compensations. For example, in the last years you have seen the flood in Kerala, and the Kerala government paid many people some 10,000 like that, and some for some people they reconstructed their houses, and for some people they gave money to construct the new houses like that. Okay, so these compensations are not taxable, because this is to compensate the disaster. And this year this corona, and this year also this rain is coming, so some disasters, if some disaster happens, the government or some other this is actually if government pays some compensation to that, we need not pay taxes for that. Okay, then retrenchment compensation, and compensation on payment on voluntary retirement, payment from statutory PF, RPF, superannuation fund, HRA, etc. These things I do not explain, this HRA, payment from statutory, RPF or PF like that, because in the coming chapters we are going to explain that. You know that we cannot say the whole money is not taxable, but from the whole some portion will be exempted. So that exempted portion will not be added to the total income. This is what we are going to explain. This is what we are explaining the heading. Okay, this is the amount is not included in the total income, nor it is taxable. So that means if one person is receiving HRA or some other money, or some compensation like that, gratuity or compensation like that, he received the whole some money. Don't think that the whole money is not taxable, but out of it some portion is exempted. That portion will not be included in the total income, nor it is taxable. Okay, the second part is income which are included in the total income but are exempt from income tax at the average rate of income tax applicable to the total income. First, they will be included in the total income and will be deducted or exempt, will be shown as exempted on the average rate of income tax. There are only two, three items in that category. You can just refer Mehrotra Goyal chapter 4 for the explanation. Only 2-3 items are there, and you just write a note on that. Keep it with you. Okay, that's all. Thank you for today. That's all. Thank you.